Good morning, and I'm starting 2015 with a video update as there were a lot of important observations that are there in the market overnight. Primarily, as I discussed yesterday, the Indian markets closed negative for the month across most indices, but so did the US market. The Dow, the S&P closed negative for this month because of the sell-off that we've seen overnight. But what was the more interesting observation was what I discussed yesterday on the commodity and currency front. The post that I put out, I was looking at a potential bottom in the euro and maybe the completion of a five-wave decline in several commodities. The point I'm trying to make here is that just like we see in a bull market, every overbought reading gets extended higher and higher, and in bubbles it goes on even at higher time frame degrees. What we are seeing right now is extremely unusual. It is not normally seen in cycle degree or normal corrections. Even in an uptrend, when you get a correction or if you get a larger degree bear market corrections, you get bounce backs. But only during bubbles, when there is excess unwinding taking place, that you see a sell-off continue and continue despite oversold extreme readings. The last time you would have seen that was in the sell-off after 2008 in the commodity space. We would have seen it in stocks way back in even 2000. Including in stocks like Disco that continued to fall, after 2001, despite extreme readings, and we are seeing that happen right now in the euro, and we are seeing it happen in the commodities, especially crude, but also I think mostly in crude, but also the CRB index. And so far, it has probably not had the same kind of impact on some of the base metals, but we are not getting clear trends in the precious metals. So, I'm starting with the euro here. Yesterday, I showed that maybe we could end a fifth wave because the fifth wave has started, but it continued to subdivide into 1, 2, and 3. It broke below the neckline, which was at 1.211, and that indicates that that's a major break, indicates that the trend down is likely to continue a lot further overall. And day before, I did show the USD CHF, that is the Swiss franc, also extending into a third wave. So when I was marking the euro, I was not sure either one of the two is going to be wrong. And every time I discuss other currency pairs, I always highlight that despite the extreme readings that we see on the dollar index or the euro in terms of sentiment indicators, most other currency pairs show incomplete wave counts. They've not completed a five-wave advance, and they're in a pretty long multi-week, multi-month uptrends that are not complete. So therefore, you cannot get a significant bottom in the euro or a significant top in the dollar index based on what we are seeing across the board. And almost each and every currency that I look at, and have expanded the number of currencies that I look at over the last couple of years, all of them now have turned from down to up, and by that I mean that they are all weakening against the dollar. The dollar has started to get stronger across the board, across currency pairs, which is a very unique trend that we are seeing right now. So the euro's break now indicates that it could be headed to below the 1.2 mark, maybe even lower overall. And because it does show oversold readings, you keep getting these small bounce backs, but probably the trend down would continue. And with that perspective, when I switch to the chart of crude, yesterday I marked it as a possible 5, and it again broke that low. The intraday chart showed a 3-wave rise, it did not form a 5-wave rise. And every time that happens and it extends on the way down, which means prices are probably headed to that next pivot, which I discussed in last week's update, closer to the $48, $46 range. And that's one more extension going on. The same thing happened to the CRB index as well. The CRB index, which yesterday I said could be ending a fifth, once again broke its low. So it's just continuing to extend despite low readings. The RSI is 23 on the daily, 14 on the weekly, same in crude, and these prices just continue to extend down. And this is, like I said, it's unusual. It means that structurally something has changed in the commodity market. This is not a normal, as they say, garden variety correction. This is something structurally changing because extreme readings are just not working, and prices just continue to unwind on the downside. So I think this has become one trend that unless it's complete, we are just not going to know that it's complete. So you can't really buy the bottoms every time we see 5 waves down means you start looking for signs of a reversal. But if you don't get it, you don't really buy into it. At the same time, because it's so oversold, initiating fresh shorts is usually not recommended. But the ideal thing to do is just keep trailing if you're holding on to a position from a much higher level. Uh, and then that brings us to the precious metals. The precious metals did complete what looked like 5 waves down into the bottom that we saw in November. Both gold and silver in some way were looking complete, but what we've seen on the way up is that they've not made clear impulsive moves. Now there are two possibilities. One is, of course, that they're forming what could be a multi-week or a multi-month triangular pattern. It could be a symmetrical triangle, or it could also be an ending triangle, which means it could be downwards, making a low and a high. And because this structure is not very clear, the ideal thing to do, and we don't even have a clear 5 wave sell off, at least not in gold. In silver, it is possible to consider that. We can't really trade the precious metals very well at this moment for the short term, and since we don't have a bigger trend uh, clarity because we don't have an impulse on the way up, we can't simply take long positions and hold on to them. So that makes the positional trade almost impossible right now, and the short term trade a little difficult. So unless you're just moving in and out for a day or two, I think this is going to be one difficult space till we really get confirmation on gold and silver. Okay, so silver, however, and note both gold and silver have closed positive for the month, so that's an indication that something completed. But what completed, is it just a minor counter trend move, retracing some of the losses, or is it just an indication that yes, we pausing for an ending triangular pattern? So that continues to form. This is a chart of silver. In this, it's far more clear that the bounce back from the late November, early December low was 3 waves. I'd mark that as ABC. I can take the entire structure as a 3 wave pattern, in which case we are still forming B, because yesterday again we saw a sell off from the high, and the rise is again not impulsive. So it could be A, B, and C on the way down, and how far down it could be anywhere between 14 and a half to $14. So this again leaves open a developing pattern, which could be triangular in nature till it's clear that we get an impulse down. And the other alternate, as I discussed in one of last week's updates in both gold and silver, is if we consider this entire structure to be wave A, the counter trend move going on right now is only wave B, and then a larger C down develops, in which case prices can fall much further in both the precious metals, as long as we are seeing a dollar rally and we are seeing the continued selling in commodities. And that brings me to the last one, that is copper. And copper has really not given us the kind of sell off that we would have liked to see, given the way crude sold off or gold sold off. And it's continued to take support on this multiple base trend line, giving hope every time that probably it will bottom here. This level is at $2.76 now, and any break below that would mean that we are not getting a move up, and probably it's joining the extended sell-off on the downside with the rest of the commodity. So it's not confirming it. Even yesterday it didn't go above the 20 DMA, which is at $2.87, and therefore it's not confirming any kind of a near-term reversal. The short-term momentum indicators keep switching from buy to sell, and therefore that gives us a lot of false signals. So using moving averages or trend lines would be a better idea out here. So in short, what all of this is telling us is still we have a very clear-cut confirmation. We are seeing some kind of a major structural sell-off in the commodity space, and what it means and what impact it will have on the rest of the market is still not apparent. It is being discussed that it's a sign of slowdown. It could create problems in various debt and junk bond markets, especially in the case of crude. But many of those effects would be seen months down the line. So equities have still not reacted to those possibilities sharply, but they remain open risks. And with that, I come to today's headlines and what has been going on in our own market. I've been discussing this theme for quite some time in my write-ups, and but economic movements are usually very slow, and in the interim, a lot of hope, fear, greed gets built up. But no matter what the indices in terms of the Nifty itself does, the macroeconomic theme that I've been forecasting and have been writing about has not really changed. Uh, Essentially, what I talked about a couple of years ago was that uh, we were seeing a highly inflationary period, and at that time it was apt that we should have taken measures similar to what China did and tighten. Of course, that would have hurt markets and probably the economy in the near term. But we didn't do that. We continued to postpone those issues, and finally we have the new governor who's actually walking on those lines, saying that no, we need to solve the inflation problem first. Only then can we really cut rates and spend. Now that is exactly right, because over the last several years of inflation, what has happened is that it has allowed the debt to GDP ratio of the government to actually come down a little below the close to or below the 60% mark. However, the private sector continued to remain leveraged and probably has borrowed even more to tide through this difficult period, and therefore their ratios have remained constant or moved higher as a percentage of GDP. So this makes it a little difficult for the private sector to go out and simply invest. And then when you look at this headline, it essentially talks about the same thing. The government is now in a low inflation period, facing the problem of growing revenues, and with that, it's happening to having is forced to tighten further. Now, the choice is a difficult one. Do they just spend out and deal with inflation again, all over again, 6 months down the line? And if that's not the path that they're taking, if it's pretty clear that's not the path, at least till now, then the only alternate path is that they're going to be cutting back on expenses, and that means that domestic liquidity continues to tighten, and then the only source of liquidity remains the external side, which means we are completely exposed to what is going to be happening on the global side from here on, and not to what is happening internally. Because internally, if it's unlikely that you get more spending from the government to create growth, then probably growth is going to remain an issue in the months ahead. What can still be a kicker though is that you get interest rates actually coming down, and that would provide some kind of domestic liquidity to boost the markets. And it's still not clear how that would happen. My long-term charts continue to indicate that the bond cycle is not complete, and if some kind of global liquidity issues come up, then again you'd face risks on the interest rate side. So I don't think that part is completely clear. And in the interim, what the government is having to do is it's having to find new ways of raising revenue, whether it's raising the uh, duties on oil, something that's been popping up in the papers again and again. That's one means of doing it, because falling oil prices are actually providing the cushion to take that extra revenue onto its books. And the second is the next headline that we got today, is that you actually raise money by selling more airwaves. And that would probably help tide some of the gap on the fiscal side. But again, when you look at this headline, what I see is that it immediately means a reduction in liquidity, because a lot of money gets actually sucked out of the system when you do something like this. It's very similar to what you do when you divest. It's also similar to when we talk about the NPAs in the public sector banks, and we say, okay, we need to recapitalize the banks. And if you're going to recapitalize the banks, which means you're going to give them more equity, the equity base expands and the earnings come down. So in the near term, that does not end up being a positive trigger for the public sector banks simply by recapitalization. The real trigger for the financial sector essentially comes from growth, which means growth in lending, and hopefully lending that does not result in more non-performing assets in the long run. So my takeaway from these headlines remains that we are in a tightening environment. We are going to see liquidity remain tight, even though markets are not discounting it yet, and we get exposed to global risk, which is essentially, as I've already discussed, some kind of a major structural change in the commodity markets, which can likely have an impact on global equities and the global bond markets, and eventually put interest rate pressures on us as well. And in the meantime, the crack in the euro means that the dollar index, the dollar rally continues, which means the ongoing currency war, if you might call it that, because we are seeing an across the board sell off in currencies against the dollar. Is something that we are going to have to deal with. I don't see much choice, but the rupee would have to be devalued. If not, if it doesn't happen on its own, then the pressure to actually do it through the RBI actually intervening would come up at some point of time. Right now, the talk is only of managing volatility, but in future, my sense is the talk will be more about managing devaluations. The alternate scenario, which some of the media has been speculating, and if it does turn out true at some point, is that under the pressure to grow and with the RBI not relenting on rates, the government does step in, if not on the spending side, then in some way to manage and convince the RBI that we start cutting rates. It would be a very different scenario if we start cutting rates and devaluing the currency. We'd be doing something very similar to what probably Japan or China are starting to do. And that in the very short term can be a positive trigger for the equity markets. Although when I think of it broadly, it means that the falling currency would actually make a lot of the Indian debt uh, uh, a little less attractive because you would have lower rates. And given that a lot of the inflow by FIs has been on the debt side, that would create an additional pressure point both on rates and the currency. So, not a lot of good alternatives. But typically, when you go into the inflation mode, which means you want to cut rates and you want to inflate the economy, you want to lower the currency. That's one way of dealing with the excess debt problem, because how do you really deal with the large debts and NPAs, even if it's in the private sector? One is you help them through inflation. The inflationary impact of the last several years, last 5-6 years, has not really been positive for the private sector, only for the government, which has been able to lower its ratios. And therefore, I'm not really sure how the private sector gets over it. And if we attempt that path again, hoping that inflation would solve the problems for the private sector, then I really wonder. It might push up the stock market in the near term, but I'm not really sure how that really ends. But the path visible so far at this point of time, based on all the reports that we are reading, is that we are still continuing down the path that RBI has outlined, which is first solve this inflation problem, and then deal with interest rates, because if you lower rates right now, you could have many other problems related to the currency and to the debt markets, which cannot be overlooked. So that in a sense puts us in a tightening mode and a disinflationary mode for several more months to come. And the key risks therefore to watch out for are going to be global. It's no more going to be domestic, the R market, because all the liquidity is going to come in from the global side. The movements of the next several months are likely to be driven by what is happening on the global front.